In a recent interview, legendary short seller James Chanos shared a cautious outlook on one of the most anticipated IPOs of 2026, SpaceX. According to Chanos, the SpaceX IPO reminds him of periods in market history when investor enthusiasm reached extreme levels. He compared today's environment to the late 1990s dot-com boom and the 2021 meme stock and SPAC frenzy, arguing that massive waves of IPOs and secondary offerings have historically been warning signs for investors. Chanos believes 2026 could set records for equity issuance, with companies like SpaceX, OpenAI, Anthropic, and others potentially flooding the market with new shares. In his view, this surge in supply suggests that demand may finally be peaking after several years of strong market performance. One of his biggest concerns involves xAI, Elon Musk's artificial intelligence company. Chanos noted that earlier projections emphasized xAI's ability to develop and monetize advanced AI models, such as Grok. However, he argues the company appears to be shifting toward a neo-cloud business model, leasing computing capacity to AI firms rather than creating higher-margin AI product itself. According to Chanos, this infrastructure leasing approach resembles a data center or equipment rental business, a model that typically receives lower valuations in public markets than AI software developers or hyperscale technology companies. He also questioned the timing of the strategic shift, noting that much of xAI's projected market opportunity was originally tied to AI software and enterprise solutions rather than cloud infrastructure services. More broadly, Chanos argues that much of SpaceX's valuation depends on investor expectations rather than current financial performance. He referred to this as the Elon Premium, the extra value investors assign to companies associated with Elon Musk because of expectations for future breakthroughs. While Chanos acknowledges that Starlink is a legitimate and growing business worth hundreds of billions of dollars, he remains skeptical about the overall valuation. He pointed out that SpaceX is reportedly valued at well over 100 times annual revenue, a level he says has historically produced poor long-term investment returns. He also highlighted ongoing risks surrounding Starship, SpaceX's next-generation rocket program. According to Chanos, Starship has yet to fully achieve its long-term operational goals, and the success of many future SpaceX ambitions depends heavily on the rocket's development. When asked whether today's AI boom resembles the dot-com bubble, Chanos argued that the current investment cycle may actually be larger. He pointed to the enormous capital spending on AI infrastructure and data centers, warning that technology spending booms can temporarily inflate corporate earnings before eventually slowing down. Despite his skepticism, Chanos emphasized that he is not predicting an immediate collapse. Instead, he argues that investors should be cautious when valuations become disconnected from underlying business fundamentals. His message is straightforward. Extraordinary expectations can drive stock prices higher for long periods, but eventually investors will demand real revenues, profits, and cash flow to justify those valuations.